In this video, we are looking at Newman Manufacturing, who is considering purchasing the stock of another company called Grips Tool. During the year that was just completed, it tells us that Grips earned $2.88 per share, and they paid a cash dividend of $1.18 per share. So our D sub zero, our most recent dividend at time zero, is $1.18, and we're expecting that Grips's dividends will grow at 35% per year for the next 3 years, after which they are expected to grow 7% from years 4 to infinity. So we want to know what the maximum price per share that Newman should pay for Grips, and that's assuming that Newman has a 10% required rate of return on its investments. So first thing we need to do is figure out the dividends for the next several years that we will then discount back to time zero to figure out what the value of the stock is or should be. So we can do that, and I've kind of jumped ahead just to save us a little bit of time in the video. So here you can see our baseline dividend of $1.18. That was the dividend that was most recently paid by Grips. And then we have our dividends for year one, which again we're going to grow at 35%. Dividend year two, again growing at 35%, and dividend after year three, also growing at 35%. And then since we'll need the first expected dividend during the second stage of growth at 7%, go ahead and calculate the dividend at the end of year four, which is $3.10. So how do we get this dividend? Well, first of all, we're starting with $1.18. So dividend for year one is just $1.18 times 1.35. We're just raising it up 35%. And then the year two dividend would be the $1.59 times 1.35. Dividend at year three is the $2.15 times 1.35, and then to get the year four dividend, we're taking $2.90 and multiplying that times 1.07, because again, the growth rate changes to 7% starting in year four. All right, so looking over here to the right, we have just a simple timeline to kind of reflect this visually with our very first baseline dividend of $1.18. And we don't really need this at this point. We use that figure to help us get the dividends for the future years. Again, we're sitting here at time zero. The rest of this is all future expected or forecasted dividends. So $1.59, $2.15, $2.90, these are our first 3 years of dividends that are all based on the first stage. So we call that stage one of expected growth. So this is stage one. So this, as you can tell, is just a mixed stream of cash flows that we can use the NPV function for to discount this back to time zero. So we're going to take these three dividends, use the NPV function, and figure out what the value of the stock that's attributable to the first stage would be for Grips Tool. And for stage two over here, again, this is a growth rate of 7%. So this is stage two. I like to draw somewhat of a separating barrier here just to show the difference between the two stages. The price at the end of year three is what we're looking for, based off of the fact that years 4 on are going to have a different growth rate. In this case, again, it's 7%. So how can we find the price at the end of year three? Again, this is assuming we're out into the future, standing at the end of year three. What would that price look like based only on the year 4 through infinity dividend? Well, we can find that by using the constant growth model or Gordon growth model, where it says that the next year's dividend, in this case, dividend for year 4, we may be used to seeing dividend D sub 1 for next year's dividend, but in this case, D sub 4. And we divide that by the required rate of return. In this case, again, it was given as 10% in the problem. And we subtract the growth rate. Again, in stage two, it's 7%. So if we plug those figures into the formula, the next year's dividend year 4, we had already calculated as $3.10 because we anticipated needing to use that number anyway. And we divide that by the required rate of return of 10%, it has a decimal 0.10, minus the growth rate 0.07. Okay. Now once we have this answer here, which comes out to be $103.33, we could then discount this figure back to time zero as well, so that we have the value of the stock at time zero that's attributable to the second stage of the model. What's left then is to complete a couple of time value of money calculations using Excel functions to figure out what the stage 1 and stage 2 portions of the stock value are, and then add those together to have our final answer. So let's go back to stage 1. We have dividends that we've calculated for years 1 to 3, and we'll use the NPV function in Excel to figure out what the present value of those 3 dividends is. So the required rate is, again, 10%. Our values are 159 for year 1, 215 for year 2, and then finally 290 for year 3. And that gives us a present value of $5.40. Again, that is the value of the stock that we can attribute to that first stage of the two-stage variable growth stock valuation model that we're working on here. So that's $5.40. And then for the second stage, we had, again, a price of the stock out at the end of year 3 that we found using the constant growth or Gordon growth model. That was 103.33. So that is just a lump sum value that we need to discount back to time zero. And that's, again, just using the present value function with Excel. So if we go back to the present value function here, the 103.33 is the future value. Our rate is still our required rate of 10%. Number of periods is 3, because again, that 103.33 is at the end of year 3, so we're going to discount that back to time 0, which is 3 years away, and we get a value of 77.63. I'm going to put a negative sign in front of the PV function just so that it returns a positive value in the end. So that gives us 77.63. And then again, all we need to do is just add up the sum of those two figures to have our total stock value or estimated value, current value of GRIP's tool. So we can add these two up, and we would have a total stock value for GRIP's of $83.03. Now there is a slightly different way that we can get our answer without breaking this up into two different time value of money calculations. So you'll see this potentially in some other examples, maybe with the text or the lab. But if I were to go back and just get rid of a couple of things here. If we were to kind of wipe out this second stage division that we had here, and just go back to the fact that we are still have our price at the end of year 3 of 103.33. If I were to just simply tack that 103.33 onto the dividend at the end of year 3, again, because those are both end of year 3 figures. So if I was to draw in the 103.33 up here, and we just add those two figures together, which would be 106.23, I can then just use the NPV function for my three figures, again, 159, 215, and now 106.23. So watch here as I use the NPV function. And we enter our required rate of 10%, value 1 of 159, value 2 of 215, and value 3 now, instead of 290, I'm going to enter 106.23. And notice how we get the exact same answer, 83.03 that we got previously when we added up the results for the stage 1 and stage 2 parts. Okay, so that's, again, just another way that we can get the same answer, but without having to perform two separate time value of money calculations in Excel.